Welcome to the Man from Macro, where we're going to look at some of the latest developments in financial markets. And I think perhaps the most interesting narrative at the moment is whether we're going to see a reflationary type story before we hit a recession, with some people thinking that a recession may not materialize, although there are some indicators suggesting very much that that narrative is still very much at the forefront of a lot of people's thinking. But first off, what we're seeing is grinding higher yield. So this is the 10-year yield and the 30-year yield, which tend to be more sensitive to things like growth and inflation. And this is very much a bond market story that's playing out at the moment. When we look at things like MOVE index, which is bond volatility, versus the VIX, we can see that it's very much the bond volatility which is still relatively high, which is maybe to be expected considering that we are seeing these new multi-year highs, in fact more than a decade high in those yields. But the VIX, the volatility on the equity index, this is on the S&P, is still relatively well behaved at around the 17 level. And this in some ways reflects that the equity market itself is still within a one-year range. When we look at the S&P 500, it's been moving higher in this very much parallel trend channel that we've been seeing. It is testing the bottom, and we should be watching this over the next few days to see whether this move that we've seen through September continues. Now, just one word of warning there is that since 2020, we have seen a weak September followed by a rally into year end on every single year since 2020. So at the moment, it's still conforming to those previous years. But we are still seeing some other areas where we are maybe seeing a tightening of financial conditions. And this is really where we are looking at the things like the dollar, the DXY, which is still 57% of the euro. But the DXY, the dollar, has been grinding higher, and that's tightening financial conditions. And we are seeing some of the more higher beta sensitive sectors within the FX market also showing weakness, as you'd expect. But the fact is that things like the Aussie dollar, which should be a reflation asset, is actually very much on the back foot, as is the JP Morgan EM FX index. Now, emerging market FX and the Aussie dollar should be doing a lot better if it's true reflation that we're seeing. So therefore, is the reflation trade actually much more of a distortion in a certain part of the market rather than true growth coming through? And I think what's very interesting is that we are starting to see things like the total employees within the transportation market within the US is starting to roll over. This was a chart that I've recreated from one that I saw from Game of Trades on Twitter. But as you can see here, all employees within the transportation sector is rolling over. Every time it's rolled over the last 30 years, we've been in a recession apart from one occasion. That was 2014. And back then we were in an industrial or profits recession. So this rolling over is certainly an indicator that historically over the last 30 years, things are starting to turn down and we should expect a slowdown to materialize. We can also see copper, the difference between copper and oil. And this is perhaps where the problem lies, is that oil has been grinding higher, but is that a supply distortion? Is that OPEC creating this tightness of supply at a time when demand is still relatively robust? And demand for oil, because it's kind of everywhere at all times, even in a recession, doesn't pull back dramatically. Whereas things like copper, Dr. Copper, which is that reflector of a global economy, that has been trying to break down. So what can people do? And remember, this is all for engagement purposes rather than actual investment advice. But I'm going to go through one or two things that we can look at to see how this is playing out. And the first one we can look at is this ratio between the energy sector and the broad market, particularly in Europe. We have seen the energy sector outperform the broad market in 3 of the last 4 recessions, the one being where it didn't happen being 2020. And that was because everything shut down due to COVID, and that's why we saw that particular weakness. But otherwise, we have seen the energy sector outperform. It is a relatively defensive sector through a normal, common or garden recession. And then the second one, if we think that copper is breaking down, is the basic resources sector here within Europe. Now, this has been testing a neckline. It's not broken through yet because it's still fighting these contradictory forces between this reflationary story, which would see things like miners doing well, versus the recessionary story where these higher beta sectors, these cyclical sectors such as miners, tend to underperform. So far, it hasn't broken down, but if you think there's a risk, then maybe that's a trend line or a specific catalyst level, an inflection point, which we can play for potential downside. And if it breaks there properly, we should expect those miners to accelerate lower. And then one other area which I think is fascinating is gold. Now, gold has been breaking lower as well. As we can see on this chart, it's actually had quite a dramatic move lower. But this at the same time is seeing gold reach its most oversold since 2018. And this is a chart from Tavi Costa from Crescat Capital, who's been watching this gold price rolling over. But at the same time, we've actually been seeing gold performing relatively well compared to what we might have historically expected, and it is now oversold. Now, I wouldn't necessarily want to be long this sector because, as we've seen before, when yields are going higher, gold tends to underperform. But this is where we've got to think about whether this is the final denouement before we actually see a recession kicking in. Are we seeing these reflationary assets going higher because actually what we're seeing is yields going higher is eventually going to break the back of the market? Eventually we'll get the recession and eventually we'll get the response. There is risk for gold before that, but implied volatility of gold, and this is the 3-month volatility chart, is towards the bottom end of its long-term trend. So maybe the way to play gold is by looking at the options market and maybe buying some calls out 1 year. And the reason why we might want to do that is because we still don't know the timing. There's still a lot of uncertainty. We could get that reflationary impulse first. And this is something that we saw in 2008, where WTI hit $150 only a couple of months before Lehman imploded. That was an inflationary or reflationary impulse that had a lot of people thinking that the recession was over, just as it was about to accelerate. And one of the reasons why I might want to look at options on gold rather than an outright position is because of the long-term relationship between gold and real yields. And for that, we're just going to go off to my colleague who's going to run through the chart of real yields inverted versus the gold price.
Thanks, Roger. So, gold has pulled back and it's now the most oversold since 2018. Why wouldn't we just go out and buy it? Well, that's because of its relationship with real yields. This chart is US 10-year real yields inverted against the price of gold. When real yields rise, gold tends to fall. And vice versa. But what you may notice is that the gold price has not fallen anywhere near as much as real yields have risen. Remember, real yields are inverted here. It does look like something has materially changed. Gold has performed relatively well, and if we are now heading towards recession, there could be significant upside in the gold price. It could even take out the highs around 2075. However, there is still the risk that the gold price substantially reconnects with real yields before a recession takes hold. That's why it could be better to look at buying longer-dated calls on gold rather than an outright position that might get stopped out. The premium on the option is your maximum loss, whilst taking a longer-dated position gives you time for a recession to play out, with the potential for central banks to revert back to easier policy again. An environment which gold has generally preferred over the last 15 years. And remember, this is not investment advice, it's purely for educational purposes, highlighting some of the trends that we're following in the market.